last few days, my phone hasn't stopped ringing. Ashish, gold and silver prices have shot up. What should we be doing? Should we stop equity SIPs and start in gold or silver? How far will it go up? I get it. When something suddenly goes up, it feels like you have missed out. But when everyone starts rushing to invest in the same thing, that's usually when I start getting a little worried. So I thought, instead of answering you all one by one, let me make a quick video for everyone, sharing what I've been telling people on one-to-one basis. So for all of you who are planning to invest in gold or silver, do watch this video. Before you make the purchase, the first thing you need to do is to look at your portfolio composition. An ideal portfolio should comprise of 33% equity, 33% real estate, and 33% defensive assets. Things like debt, bonds, metals like gold and silver. Within the defensive part, gold and silver together should make up around 10 to 12% of your overall portfolio. Now, if you look at your portfolio and you realize you have almost nothing in gold or silver, you can start building that exposure now that it has your attention. But please don't jump in with a lump sum. Start a SIP, because honestly, no one knows whether the next move in gold and silver is going to be up or down. And if you invest a lump sum and it takes a downturn, you won't be very happy. It might even shake your confidence. I often say this: when an investment goes wrong, you don't just lose money, you lose confidence in investing altogether. And that's the real damage. So protect yourself against that by investing systematically and making the most of the averages. Now, the second thing you ought to do is to ask yourself, why I am buying gold or silver now? Is it because I expect high returns, or is it because everyone else is buying and I don't want to miss out? If your motivation is returns or FOMO, pause for a second. Will you invest in an asset class if it had given only 5% return since 2011 till date, or which has fallen over 55% between 2011 and 2016? Or from 91 to 2001, the returns were flat? That's the story of silver. If you look at the history, gold's journey hasn't been a straight line too. For 20 years, between 1981 to 2001, gold gave almost no returns. It had multiple years of near zero or even negative returns, some as low as minus 14% in 1997, and long stretches under 5%. Hence, if you bought gold in 1980 and held it till 2001, your real returns after inflation was almost zero. After peaking in 2012, gold fell to minus 10% in 2013, stayed weak through 2014 and 15, and basically went nowhere till 2018. So if you're looking at gold today just because you have seen recent double-digit returns, remember, this kind of phase could be followed by a flat one. That means you could see no returns for years or even a temporary loss if you can't hold it long enough. This brings me to the end of today's video. But I want to leave you with something I've learned in the last 2 decades. Gold and silver are not meant to make you rich. They are meant to protect you when things go wrong, when markets fall, when inflation rises, and when uncertainty hits. They are hedge, not a jackpot. So if your portfolio doesn't already have 10 to 12% in gold or silver, start adding it slowly. But don't chase them for returns.